Welcome back to the Daily Crypto Deep Dive. And today we are talking about one of the biggest stories in crypto right now because this is not just another headline about regulation, and it is not just another politician saying the industry needs rules. This is about the Clarity Act, and whether the United States is finally about to decide what crypto actually is, who gets to regulate it, and which parts of this market are built to survive when the guessing ends. This episode is sponsored by Kraken, our official exchange partner and the platform we recommend if you want a reliable place to buy and trade crypto. Whether you're stacking Bitcoin, picking up XRP, or building a long-term portfolio, Kraken makes it simple, secure, and easy to use. In a market full of noise, that matters. So if you want an exchange with a strong name in crypto and you want to support the show while you do it, use our Kraken link in the description. For years now, crypto in America has been trapped in this strange middle ground where billions of dollars have been flowing through the system. Major exchanges have been operating, tokens have been launched, traded, promoted, and listed, and yet one of the biggest questions has never really been settled. Is a token a security? Is it a commodity? Does the SEC control it? Does the CFTC control it? Or does the answer change depending on how the token is sold, how the network operates, and how decentralized it becomes over time? That confusion is exactly what the Clarity Act is trying to address. And that matters far more than a lot of people realize, because when a market does not have clear rules, capital hesitates. Big institutions can buy some Bitcoin through ETFs. They can take selective exposure, and they can find legal ways into the market, but the wider crypto space still trades with a cloud over it. A lot of altcoins are not just fighting weak demand or poor narratives. They are fighting uncertainty. They are fighting the possibility that the rules could shift under their feet. They are fighting the risk that exchanges may treat them differently tomorrow than they do today. So when people ask why the market feels so thin, why money seems more selective, and why investors are more cautious than they were in the last cycle, one of the answers is that the legal plumbing still is not fully fixed. Now, the simple version of the Clarity Act is this. The bill tries to create a framework where some digital assets fall into a commodity-style bucket, while others remain investment contracts or securities depending on how they are issued, sold, and used. Under that structure, the CFTC would oversee digital commodities, while the SEC would keep authority over investment contracts. There is also a transition mechanism built in, which is one of the most important parts of the whole thing, because it recognizes that a token may begin life looking one way and later evolve into something else if the network becomes sufficiently decentralized. That point is critical because crypto has always struggled to fit neatly into old legal boxes. A traditional stock is easy to understand. A bond is easy to understand. A token tied to a network that becomes more open, more distributed, and less dependent on a central promoter is harder. The Clarity Act is an attempt to build a bridge between those realities. But here is the thing. This bill is not just about labels. It is about power, and it is about access. Once you define what something is, you define who can touch it, who can list it, who can market it, how it can be sold, and what kind of disclosures the platforms around it have to provide. So this is not some loose pro-crypto free-for-all where Congress just waves everything through. It is an attempt to build rules that are supposed to be clearer, more investable, and more credible than the patchwork system the industry has been living with. And that is why this story matters for your portfolio. Because if the market starts to believe that America is finally going to produce a stable rule set, prices will not react evenly. Bitcoin is already the cleanest institutional asset in the space. It has ETFs, it has global recognition, and it is increasingly treated as its own category. So Bitcoin probably benefits from clarity simply because clearer rules reduce friction and support broader capital formation. But where this gets more interesting is in the rest of the market. The coins that sit in regulatory gray zones could suddenly be repriced based on survivability. The winners may be the assets that can live comfortably in a regulated framework. The losers may be the tokens that only ever thrived when nobody was looking too closely. And that brings us to XRP. Because whether people love it or hate it, XRP is one of the clearest examples of a token whose story has been inseparable from the legal environment in the United States. The clarity debate comes after conflicting court rulings and years of legal confusion, which expose just how awkward it is to apply old legal tests to digital assets. That is one reason the market still wants a law rather than relying on courtroom roulette. A courtroom win can help sentiment. A framework can help revalue an entire sector. So if you are holding XRP, the clarity story feels bigger than just politics. It feels like a test of whether Washington is finally prepared to create a lane for assets that have spent years fighting over classification. If the market believes that lane is opening, then sentiment can improve fast. But if the bill drags, stalls, or gets watered down into something too messy to inspire confidence, then you are back in the same old problem. Uncertainty does not have to kill a project outright. It just has to keep enough buyers on the sidelines long enough to suppress the upside. Now you might be wondering, if this bill is so important, why has it not already gone through? And this is where the story gets more interesting, because the biggest fight is not only crypto versus regulators. It is also crypto versus banks, crypto versus old financial interests, and crypto versus the broader politics of money itself. One of the key sticking points has been stablecoin rewards, or the idea that holders of some stablecoin products could receive yield-like returns. Banks have pushed back hard against that because they fear that if consumers can park money in digital dollars and earn more attractive returns, deposits could flow out of the traditional banking system. Crypto firms, meanwhile, argue that rewards are central to competition and product design. And that dispute tells you something deeper about what the Clarity Act really represents. This is not just a conversation about crypto law. It is a battle over who gets to own the future rails of finance. If stablecoins become more powerful, if tokenized dollars become more integrated, and if crypto platforms can offer consumers credible alternatives to traditional financial products, then this is not a sideshow anymore. It starts to touch banking, lending, savings behavior, and capital movement at a much bigger scale. That is why the fight has become so intense. So where does the bill stand right now? The broad picture is that the House passed its version, but the Senate side remains the problem. The House version moved with bipartisan support, but the Senate path has been slowed by disagreements over stablecoin provisions, consumer protections, and how far lawmakers are willing to go in giving crypto a cleaner legal route. That means the market is now stuck in this awkward position where the possibility of clarity is real enough to matter, but not certain enough to be fully priced in. And that uncertainty is exactly why this story is such a big deal right now. Crypto is no longer a niche experiment hiding on the edges of finance. We have spot Bitcoin ETFs. We have public companies with Bitcoin treasuries. We have giant asset managers involved. We have lawmakers being forced to engage with crypto as an economic and political issue, not just a cultural one. But the rest of the market still needs a rulebook. Bitcoin may have already escaped the old conversation to some extent, but a lot of the altcoin market has not. That is what makes the Clarity Act more than just a Washington story. It is a market structure story. And when you look at it that way, you can start to see why this may be one of the most important stories of 2026. Because if the United States finally creates a framework that says these assets belong here, these belong there, these platforms have to register this way, these disclosures need to be made, and these networks can transition as they decentralize, then crypto stops being a permanent gray area and starts becoming something closer to a recognized asset class. And once that happens, the market may stop treating everything as one messy blob of risk. That could be huge for institutional participation. Big money does not like ambiguity unless the upside is so massive that it is willing to tolerate it. The more rules become understandable, the more capital can move with confidence. That does not mean every token wins. In fact, the opposite may happen. A clearer framework could actually make the market harsher. Some projects might thrive under scrutiny. Others might collapse under it. A lot of weak tokens survive in confusion because confusion hides weakness. Clarity has a way of exposing what is real and what is not. That is why the winners of this next phase may not simply be the loudest communities or the most heavily marketed coins. The winners may be the assets with durable use cases, strong decentralization arguments, credible networks, and the ability to fit inside a mature legal framework. The market may start to reward not just hype, but legal resilience. And if that happens, the whole character of crypto changes. This is also where you need to be careful. It is easy to hear about a bill like this and assume that once it passes, everything moons. That is not how markets work. Some assets could benefit immediately from reduced uncertainty. Others might actually face new compliance burdens that slow them down. Some exchanges could gain. Others could lose. Some tokens may finally get breathing room. Others may be revealed as products that only worked in a lawless environment. So the smarter question is not whether clarity is bullish in some broad emotional sense. The smarter question is, which parts of crypto are built for a world where the rules are known? And that is why this story is so relevant right now. The last cycle was built heavily on liquidity, hype, narratives, meme energy, and the idea that everything could run at once. This cycle already feels different. Bitcoin has looked stronger than much of the rest of the market. Institutional flows have been more focused. Altcoins have struggled under supply pressure. And now, sitting over all of that, is the possibility that US law could begin sorting this market into categories that actually matter. For Bitcoin, that may simply reinforce its leadership. For Ethereum, Solana, XRP, Cardano, and other major names, it raises a bigger question. Can they thrive in a cleaner, more regulated environment? Or were parts of their old upside dependent on legal ambiguity and speculative excess? That is the question smart money will increasingly ask. And the answer will likely shape the next major rotation in crypto. So when you hear people say the Clarity Act could change everything, that is not just empty drama. It really could. Not because politicians suddenly love crypto, not because one bill solves every problem overnight, but because markets reprice around structure. And if structure finally arrives, the market starts separating the survivors from the passengers. For years, crypto has wanted legitimacy without always wanting rules. Now it may have to prove it can handle both. And if it can, the assets that emerge strongest from this phase could become the foundation of the next era of the industry. If it cannot, then a lot of projects are going to discover that they were never built for the world they claimed was coming. So the real takeaway from all of this is simple. The Clarity Act is not just another boring regulation story. It is a test of whether crypto is ready to grow up, whether Washington is finally prepared to draw the lines, and whether your portfolio is positioned for a market that may soon care a lot less about noise and a lot more about what can actually survive under the light. And that is why this matters so much right now. Because once the market gets real clarity, it may never trade the same way again. Drop your thoughts in the comments, smash like and follow. And as always, we will see you at the top.